Welcome, everybody. Today's presentation is being presented by UHY LLP and Becker LLC. Today, we're going to be talking about the home stretch, ensuring that you maximize your PPP loan forgiveness and successfully navigate the SBA questionnaire. Today, we're going to take a little bit of a different approach to how many of you probably have seen webinars over the last, 10, 11 months since the original CARES Act came out. We have found that this roundtable format seems to work best for everybody, is it allows us to monitor questions, allows us to put questions we've been seeing that people have been asking, and then give you information based on what we've been seeing the last couple months, both on loan forgiveness and on the SBA questionnaire. As we progress through this, we will be bringing up certain questions and certain comments, if we have time, on the new PPP2 and potentially some of the ERC. There's been a lot going on. You know, we've all been navigating this crazy world we live in the last 10 months. We're finally into that home stretch for PPP1. We all thought things were going to go a little smooth, but then what happened is we get this questionnaire that gets sent out, and it sent everybody into a small bit of a tizzy. I'd like to introduce myself. I am Jerry Grady, the Staffing Industry Practice Partner over at UHY LLP. With me today is Lonnie Winkler, who's a principal in the firm, as well as Ali Beydoun, who is a principal in our firm as well. Both Lonnie and Ali have been instrumental in the PPP applications, monitoring all the updates on the PPP, as well as making sure that the loan forgiveness and questionnaire for those over 2 million, we had a good, as best handle as you possibly could. UHY LLP is a national CPA firm with approximately 25 offices across the country, approximately 1,200 CPAs, and inside our staffing practice unit, we have approximately 25 people. On the phone with us today is Martin Barasco, who is the managing member at Becker LLC. And if Marty, if you could go ahead and introduce your team.
I'd love to, Jerry. Thanks for having us today. And today I've got Chris Letty with me. Chris is a former general counsel at a staffing firm and joined Becker several years back. Chris's background is in employment compliance, staffing industry contracts, and last March, thank goodness, Chris agreed to jump headfirst into the CARES Act, and similar to Lonnie and Ali, has followed the CARES Act step by step and turn by turn through today, and really been hands-on with our clients in terms of their forgiveness applications and their responses to questionnaires. And for those of you who don't know me, I'm Marty Barasco. I am the practice leader, the staffing industry practice group leader at Becker. Similar to Chris, I've been working through PPP related issues with our clients. My focus has been more on the certification process, the potential audits, and now, of course, the somewhat surprising questionnaire. So we look forward to talking with you guys as always. We always enjoy our chances to chat about the PPP with you folks over at UHY.
Well, thanks, Marty. We really appreciate you guys jumping in on this. And I know our first section that we're going to dive right into is going to be a brief overview, about 15 or so minutes, over on the forgiveness. And then we'll dive into the application. And one of the things that I just wanted to give some commentary on the application is that for many people we've been working with over the last couple months, there still is a lot of confusion on what's going on, when to file, how do you calculate FTEs. I mean, I know that all of us have a really good handle on it, but I really found it interesting how many people were struggling. Even some of our small clients who might have only had a $150,000 loan were still struggling to how to fill out that application. So I think it's really great of some of the changes that did come about for the smaller firms, but also some of the things they added into the second round on December 27th when it got signed. There's some more positive things for people, and I'm sure you guys will be addressing that. So Marty, if you want, why don't you go ahead and start, driving down some of the things we've seen and some of the questions we've been handed lately from some of our clients.
Sure, sure. And as you've said, Jerry, that the forgiveness process now is really moving ahead at full bore. Last couple times when we spoke, in November, it was really just getting started, but now we're really into the process. And I know the folks at UHY have learned a lot about the process and in particular how to navigate the staffing industry borrowers through it. And Chris has as well. I think the place to start, and maybe I'll ask Ali this, is it's most important now that we're into the process for folks to realize when they have to file by. There is a deadline for filing for forgiveness. And Ali, maybe you can review the rules regarding the deadline for filing your forgiveness application.
Sure, Marty. I think the filing of the forgiveness from the FAQs that were released at the time, seem to suggest that you have all the way down to the maturity date of your loan, which could be somewhere between 2 to 5 years to file for forgiveness. However, the deferment of payments that's currently in place is in place for 10 months post your covered period. So, our recommendation has been to clients to obviously don't exceed that 10-month window, because then you're filing after a period in which now you have to make payments and you don't want to put yourself in that position. So essentially, it's best to file within that 10-month period that is post the forgiveness, the end of the cover period. So everybody's going to have a different cover period end date, which is the 24-week period from the date they've received their loan. And so they should consider looking into that, and keep in mind that there's a timeline for the banks to approve this, which is 60 days, and then SBA is 90 days. So you have a 150-day potential window of review. So that covers about 5 months right there. So you want to try to do it within the first few months post of your covered period to give yourself enough time to get the proper approval before the payments have to start.
Thanks, Ali. Chris, I know a number of our clients have been asking about the length of the process from the filing of the application to the application being reviewed to a final decision on forgiveness. Can you walk folks through the statutory periods, and then if the practical reality is different, could you explain to our audience how the practical reality is turning out a little different if it is?
Yep, sure, Marty. So like Ali just said, the lender has 60 days to make a decision once you submit your forgiveness application. The lender is then going to forward the application to the SBA, and the SBA is going to have 90 days to make their determination. So up to 150 days. We're not seeing that it's really 150 days. Usually it's much faster. We're seeing that lenders want to get this off their plate as fast as they can. And we are seeing that SBA is actually requesting documentation faster than we thought, which we'll get into what they're requesting in a little bit. And you want to note that at any point, the lender SBA can determine whether forgiveness is achieved in whole, in part, or not at all. If the lender determines that you're not entitled to forgiveness, they have to notify you and the SBA. Within 30 days of that notice, you can request the lender to have the SBA review their decision, which is essentially an appeal of the lender's decision with the SBA. They then have to provide that notice to the SBA within 5 days of receipt. Also, if you do get a negative final decision from the SBA, you can still appeal further to the Office of Hearings and Appeals, and there are guidelines for that process. Again, they're all statutory, regulatory, so you want to make sure you follow that process.
Thank you, Chris. Ali, Jerry alluded to this in his introduction, and that is, especially in the staffing industry, properly calculating your FTEs is so important. Can you review that calculation and the correct way to do that?
Sure. So the calculation for FTE is a function of hours. The SBA has determined that the proper way for what is a full-time equivalent is anybody who works 40 hours or more on average per week during any of the covered period or the reference periods. And essentially, what seems to have been kind of concluded based on the rules that they've issued is you want to get to a average per week of hours worked per employee, and you divide that by 40, and you can use that ultimate result rounded to the nearest tenth as your FTE calculation. So somebody who averages 30 hours a week, if you divide that by 40, that's a kind of 0.75. You probably can round up to about 0.8 in terms of an FTE calculation. And anybody who works more than 40 hours is capped at a 1.0. Now the SBA did provide some simplified guidance to help certain clients that said, essentially, if you have an employee that does not average 40 hours a week, so anything under that 40, you can use a simplified approach and assign a 0.5 ratio to them rather than the actual result that would result from the hours. So you still have to get the hours, but what you have to do is you have to make sure that you're using that methodology in a consistent way across your reference period as well as your covered period. One question we always get on the calculations of FTEs is, well, I hired somebody for 6 weeks out of the 24-week period. Do I calculate their average just using those 6 weeks that they were working, or the full 24-week? And the answer, in my opinion, is the full 24 weeks, because otherwise you would always get a result that would be almost a 1.0 FTE, so no reductions would ever look like they happened, even by you hiring somebody for just 1 week. So you're really benchmarking them against the full covered period of 24 weeks when you're trying to look for that average of hours worked.
Thanks, Holly. Chris, I know being in the trenches with our clients and getting these applications filed and looking at the documentation that they're using to support their applications, that you've noticed that sometimes that information or reports provided by third-party payroll providers are not always providing information that is really set up to be plugged right into a forgiveness application, and there's some discrepancies in how borrowers should be reporting the information on their forgiveness applications and how it is reported from their third-party payroll providers. Can you talk about some of those issues that you've seen?
Yeah, sure, Marty. The two biggest ones I'm seeing are that they're including owner employees in the FTE values and their compensation. We have to remember that depending on the type of entity that you have, you are not only not permitted to use the owner employees toward your FTE counts, you also must back out their comp and make it subject to the $20,833 cap. And then obviously there's a formula there based on the 2019 compensation. Also, depending on the type of entity that you have, you may not be able to utilize employer health contributions or retirement contributions for the owner employees. So for example, employer contributions for health insurance are not eligible for additional forgiveness for S corporation employees with at least a 2% stake in the business, because those contributions are already included in the cash compensation. So there are nuances depending on the type of entity. So you have to be aware of what type of entity you are and what the rules say for each entity, how to calculate the owner's comp. I've also seen a lot of these reports fail to identify employer contributions towards health and taxes, and instead of just aggregating them, right? This is actually creating a lot of work for individuals. You have to be sure that you're in a position to quantify these amounts, right? If you have them just everything laid out, especially for the health insurance, right? What I'm seeing is the documentation to support it is just the aggregate. You're going to have to go back in and you're going to have to separate what the employer paid versus what the employee paid. And in some cases, staffing firms, you can have 3,000-5,000 employees. It's a lot of work.
Thanks, Chris. Chris, just following up, you had mentioned earlier in one of your, I think your first answer, that the SBA has been requesting additional documentation with respect to some of our clients' forgiveness applications. Can you talk about, what type of documentation the SBA has been requesting and maybe the reason why you think that's occurring?
Yep. So I've had a lot of clients where the SBA requested documentation that you're not required to file, but just required to maintain. So most of it centers around the Safe Harbor 2. That is, you reduce your FTE employee levels in the period beginning February 15th ending April 26th, and you then restored your FTE levels by not later than December 31st to the pre-February 15th levels. The reason that they're requesting this most likely is due to the fact that the time periods for the cover period or alternative cover period, depending on what you choose, and the reference period may be different from the safe harbor time periods, right? So, for instance, if you select your reference period for 2019, that's not going to include the Q1 941s or your state filings. So, in these cases, you want to be sure you're ready to go with your 941s, your payroll, and your state filings. They're also requesting documentation supporting that annual salaries or wages were not reduced by more than 25% during the cover period or alternative cover period for the period between January 1st and March 31st. Again, this is documentation, it has to include payroll records that separately list each employee and show the amounts paid to each employee during the period between January 1st and March 31st, and the amounts paid to them during the cover period or alternative cover period. They're also requesting documentation evidencing exceptions, and this just seems to be kind of generic. If it's not applicable to you, you would likely ignore it. And they're also requesting just generic messages for the FTE Safe Harbor 1, and that you did not reduce the number of employees or the average paid hours of employees between January 1st and the end of the cover period, right? So they just stick it in there if applicable, in pretty sizable paragraph. And a lot of clients we have are freaking out, saying, well, we don't have this information. And I say, listen, it says if applicable. If it's not, don't worry about it. If you didn't elect the safe harbor, you didn't have that one day other exception where you didn't reduce people, don't worry about it. You're not required to submit it. So just be aware of that. Don't get flustered. Know that it's only if applicable to you.
Thanks, Chris. Ollie, this has been a little bit confusing. Maybe you can clarify it. The question that I think we're receiving a lot is a question about whether non-payroll costs incurred prior to the covered period, but paid during the cover period are eligible as part of your expense accumulation for forgiveness.
Yes, Marty, they are eligible for to be included in the loan forgiveness. Essentially, kind of the spirit of the law, allows you to catch up on those expenses and use PPP funds for those. So they give you the kind of that way to use a little bit of a cash basis on those prior incurred expenses that have been paid now using PPP money. What you cannot do is you can't prepay essentially for things, right? So if the expense has not been incurred but paid for during the cover period, I think they're going to look unfavorably on that. But if it's all previously incurred stuff that you fell behind 1 month on rent that you're catching up, same thing with utilities. That was kind of the intent of the money, is to put you back on track in terms of all of these expenses. So those expenses are allowed for PPP forgiveness purposes.
Well, I wonder if you've seen any surprises. Anything surprised you as you've been, kind of in the trenches working with your clients on these forgiveness applications?
I think the pleasant surprise was, as Chris mentioned earlier, if you put the 2 million people loans over aside, which we're going to get into in detail, I think the forgiveness piece for loans under 2 million has moved relatively quickly from the banks to the SBA to actually getting decisions. I mean, the turnaround time has been around a couple of weeks. I think the initiation of the EZ form and other items kind of that simplified the process and shied away from some of the reductions that were out there have been good surprises. The unpleasant ones, we've talked about, like some of the payroll reports. Some providers were a little bit better than others, but there's still a lot of limitations, and you'd see like banks taking things at face value, right? We just take the reports, or if you are working through a portal, for example, it was a little bit challenging to try to make those tweaks that Chris was mentioning in some of those reports and kind of try to explain to somebody, hey, this is why we're not relying on exactly the number that's on that report, because it's not an accurate number, and here's kind of the bridge to get to the right spot. So there's been some challenges. But outside the 2 million, I think it's been mainly a positive process to get loan forgiveness from my experience.
We have a question that is relevant to what we've been talking about. The question is, if you buy out a lease, and I'm not sure if the audience member is referring to an equipment lease or a real property lease, but the question is, if you buy out a lease, could that expense be forgiven?
My opinion is probably not. Anything that's not in the normal due course is not going to be. That's going to be more so of an acquisition of a property rather than an actual quote unquote lease payment. In my opinion, it would fall outside the realm of what's forgivable.
Thank you. Well, let's shift gears a little bit. Let's talk about the questionnaire. I think one thing that I would implore everyone who's listening today and who's a borrower over 2 million, and that is to start to look at that questionnaire now. As I think everyone knows, the filing of your forgiveness application, if you've borrowed over 2 million, is going to trigger your receipt of the questionnaire, but you only have 10 days from receipt of the questionnaire to return it and file it. So one big important bit of advice we've been giving our clients is start to fill that out now. Work with your internal finance staff, work with your accountants and your attorneys to get that filled out, vetted, and ready to go way in advance. The questionnaire obviously is kind of a long tortured history that relates back to the original certification that borrowers had to execute when they filed their loan application. I think it might be worthwhile before we talk about the questionnaire to kind of roll through kind of the history here. Maybe you could go back and remind folks of the certification and exactly what it said.
Sure. Yeah. So at the onset, when the act was initially enacted, there was this discussion of the need to apply for loans. Typical SBA loans kind of require you not to have access to capital elsewhere, so it kind of try to be like, hey, we are the last resort that would come in and help you kind of put things in place. The CARES Act waived that requirement that was typically in the SBA Act, and when the applications kind of were launched, this certification started to emerge that current economic uncertainty made that this loan request is necessary to support ongoing operations. And of course, at the time, the act has passed and people are applying. Essentially, I think the act passed right around the 27th of March, 26th of March, and things opened up the next week or so, and people started applying and making these certifications. Then, subsequently, right around the early May timeframe, FAQs started coming out surrounding this certification that started to suggest that liquidity positions, and while yes, you don't need to have access to capital elsewhere, you should look at that. And it came, Marty, at the time, I think there was a lot of things in the press that companies such as Ruth Chris, Shake Shack, publicly traded companies that qualified based on technicalities that are afforded to the hospitality industry, were getting access to these loans, and we're getting $10 million loans, right? So the SBA caught wind of that and pretty much came out with more restrictive, rules surrounding this particular certification. And a lot of people had applied that now felt very uneasy, saying, okay, we made this certification, we didn't know that you're going to look at it this way, so what do we do now? So the SBA supplemented those rules by saying, well, if you made it prior to the May 7th date, I think you are deemed to make it in good faith, and the certification has to be made in good faith. And I think Chris can probably talk more from the legal perspective of what that good faith standard would look like. But essentially, then the SBA issued a guidance that anybody who was under 2 million and made such certification is also going to be deemed to have made it in good faith. But it gave us a glimpse as to how the SBA was going to try to look at this necessity piece of the equation when the time comes. which they started doing with these questionnaires. So that's a little bit of the history of kind of the certification, what it really entailed.
Thank you. Yeah, so this questionnaire, let's start to dig into that itself. Obviously, it kind of mirrors the FAQs, as you said. The initial focus of the act was on, adverse economic impact that the pandemic could have on companies. And then, as you indicated, they added a liquidity element. So the questionnaire really mirrors that. Part one examines and asks questions relating to whether or not, or to test whether or not the borrower has had a adverse economic impact. And then part two is aimed at looking at the liquidity of a borrower. Jerry, let me ask you this. What struck you when you first reviewed the questionnaire about any of the questions?
I got to watch what I say, Marty. I'll give my two biggest opinions were, one, it wasn't written by an attorney, and two, it definitely wasn't written by an accountant who understood what it meant to have economic uncertainty. It had a flavor of a setup, in my opinion. As I look through the questionnaire, I start seeing things like, well, yeah, if my client turns it around like the government wanted everybody to, my client starts hiring people, my client starts making money, it started to feel like, we may never get that loan forgiven, because it was a true Monday morning quarterback. It was kind of like sitting here yesterday, replaying the Cleveland Browns loss because of a fumble in the end zone, that made no sense to me. And that's pretty much how I feel about the whole questionnaire. The part I love about the questionnaire is I've seen 3 different drafts now with 3 different dates, and every single one of them still says draft on it. And so I don't even know if it's been finalized. But it really had that flavor, Marty, of that, let's just take a look at how everybody did so that we can then say you really didn't have an economic uncertainty. And what was interesting is, and I think you guys, Chris and Marty, have probably seen this, is the lawsuit that got filed in December against the SBA. And the fact that the SBA was quick to point out that questionnaire was not meant to do what we just described, that they knew very, very much that, the economic uncertainty was on that day, but that this allowed them just to get trends from everybody. I worry about, the SBA having a high school teacher looking at some of these applications right now. So I guess we just got to use our faith, and that, they really are using it for trends, and it really isn't a Monday morning quarterback situation. And I don't want to go off of this target real quick, Marty, but someone had a really good question here for Ali, that talked about breaking a lease, because a lot of people had to break leases, Ali. And my viewpoint is that breakage fee is probably not going to be added into your calculation, because the question, the application talks about what your monthly rent was. And what would be your opinion to that? Because I think there's going to be a lot of people that broke some leases to get out of them.
Yeah, I think the question, it was more related to lease, maybe buyouts. But I don't know if just a pure rental lease and breaking that lease would qualify. The whole premise was they wanted to kind of keep things paid for in an orderly fashion, and those monthly payments would qualify. Keeping in mind that, even if you have a breakage fee, your non-payroll costs are typically limited to 40% of your pool. So even if you could probably include that, you might hit some of those ceilings. But there's always going to be those situations that have not been fully addressed by the SBA on that matter, until somebody submits a forgiveness application and then somebody questions it. But given the fact that they were looking at asking for lease agreements for support and asking for the monthly payments and all that, it looks like they were more concerned with just actual monthly rents than breakage charges.
There's also Chris, maybe you can jump in on this next question. One of the audience members wondered if, since the FTE calculations are so important, if maybe you could give an example and do step by step of how you would undertake an FTE calculation.
Sure. So you take employee A, right? So if employee A, let's say and we've dealt with this quite often, employee A may have been with you for half the period, right? So 12 weeks. And it's back to what Ali was speaking about earlier. They were with you for 12 weeks. They worked 40 hours a week. They're a 1.0 value. Maybe they were terminated in week 12. So instead of them being a 1.0, they are now a 0.5, right? Because you're doing it equal to 20 hours per week would be the average over the 24 weeks. However, you would then take an exception to them, and I think this is where the portals are where people are inputting portals a little bit differently, because I know ones we did have been kind of screwy. They are then rounded back up to a 1 because you took that exception, right? So you have to be careful of when you want to make sure you're marking out who you're taking exceptions for and have their straight value and their exception value separately so you can input them correctly. And when you're inputting, what I've seen on the portals is instead of inputting a 1, you're inputting a 0.5 to round them up to a 1, because otherwise if you input a 1, they're now a 1.5. So every portal is a little bit different. Some are better than others. So you have to be aware of that fact for sure.
Thanks, Chris. We got another question, and that question is, if we have a loan over 2 million, should we complete the questionnaire in advance and just file it with our forgiveness application, or should we wait until we actually receive the questionnaire and then fill it out? My opinion is I would wait, and I would wait for the very reason that Jerry indicated, is that, this has been a moving target, this PPP process, and there's probably a pretty good chance that this questionnaire could change. As Jerry said, it's been marked draft. It hasn't even been marked as the final questionnaire. So I think your safest bet is to assume this will be the questionnaire, to work with your internal team and your external professionals to have this ready to go, but then wait until you actually receive the questionnaire. Obviously look through it, make sure it's the same questionnaire that you work through with your team, and then file it after you get it. And Jerry, there's a question out there. Maybe you can take.
Yep, we keep asking our lender repeatedly when we can expect to send us the questionnaire to initiate the forgiveness application process, and they won't even tell us when they will send us the questionnaire. What are you to do? We've been recommending to all our clients they just wait for the questionnaire, because you may not get it. There's no rule that says they have to send it. They've said they're going to send it. But what it probably also means is that your lender has either not sent the application to the SBA, or the SBA has it and they just haven't got around to sending it to you. But I think the important thing there is, Marty, is that they have to make sure that they're staying on top of their emails, because it is going to come in an email from their banker. The SBA emails the banker, or the bank actually, and then the bank needs to get that questionnaire to you right away, because that 10 days clock starts as soon as it hits the bank. And so that's a frustration that some of our clients have run into. But again, as we've been stressing, is getting that questionnaire filled out, get your thought process wrapped around it, so that when you do have that 10 days, you're able to kind of look at it again and say, you know what, I got everything I need. It looks good. I'll give it one more pass, and then you'll be ready to send it in a timely fashion. And I think, Lonnie, if I could ask you, on those two big ones that we did, those came back pretty quick though, didn't they, from the bank to the two clients that we went through, the two or larger loans?
Yes, yeah, it was a relatively quick turnaround time.
Yeah, that's what I thought. So, if you're not getting that and your lender is not responding, I wouldn't worry too much, because until you see it, I wouldn't get too uptight about it. We have heard, Marty, that some banks have their own SBA group now that pretty much has been put off limits to lending officers. I don't know if you guys have heard that, but we've heard that from a few other lenders, that they have no access to their SBA team anymore. So that could be part of the issue too.
Yeah, we've heard the same thing, that there's a small number of banks that have made that same move. We've got another question. Jerry, this seems to be a follow-up to the question you just answered, so why don't you
Yep.
answer this one as well?
Yep. Yeah. I mean, the key is if you've done the questionnaire and you've sent it in within the 10 days, you've done everything you possibly can, but that is supposed to be to the SBA. You have 10 days to get it back to the SBA. Now, the bank is set up to immediately turn that around. I mean, the minute you send it to the bank, they are just acting as a conduit. They are to roll it directly to the SBA the same day you get it. So I mean, I would not wait till 5 p.m., whatever the time zone you're in, to do that. I probably would try to get it in on the 8th or 9th day to the bank, just so you know, but keep tabs of everything you've sent. Make sure you have a file that shows you returned it in 10 days as requested. So if you send it to the bank on the 10th day at 5 o'clock, you may not get it to the SBA on that 10th day because the bank may not have seen it. So I would verify some return receipts and things of that nature, Marty, just to have it in your file, just in case.
I say treat it like your tax returns, right? You want to
Yep.
make sure you have proof that you filed it. So exactly right. That's exactly right. So Ali, a question that we've been getting from a lot of our clients, or I think an assumption that's not a lot, but some of our clients have been making, is that this questionnaire replaces the audit. Is that your understanding?
It is not. I think the questionnaire is just for them to kind of wrap their head around them, but I think they still do reserve the right to do a lot more deep dive than just the answers provided for by the questionnaire. That's been my understanding, Marty.
Yeah, that's ours too. I think this is the device that they may use to decide what borrowers they may in fact be auditing. Because I agree with Jerry, this seems to be a setup for certain types of large borrowers to me. Well, let's walk through the questionnaire a little bit, and I think we'll start with a section that I think is kind of all interrelates, and I don't know, Jerry or Lonnie or Ali, who wants to take this question, but it wasn't shocking to me that the liquidity assessment focused on 3 different things that all kind of interrelate: distributions, owners' salaries over 250, and employee salaries over 250. Could one of you kind of walk through those 3 different questions, make sure that our audience understands the difference between distributions and owner's comp in the 2 different answers, and kind of what are the traps that lie in answering those questions?
Lonnie, why don't you go ahead and do that for me, please?
I was looking for Ali to run away with it. No, so really the difference, Marty, to answer your first questions, the difference between owner's comp and owner's distributions, I think to put it in simple terms would be the compensation would be anything that you report on a W-2, right? So it's your true payroll. Any draws that you're taking are considered distributions. So if I were to look at an S corp structure, let's say, right, your distributions don't run through your payroll, and so that's the difference between the pay and the draws as far as the questionnaire goes.
Okay, thank you. And how about for an LLC with respect to guaranteed payments? Is that the same thing?
It's Ali, can you help shed some clarity on
Sure.
that for me, please?
Yeah, I think for LLC owners, for guaranteed payments, those are typically to the partners, and so those may fit under the compensation of the partners in excess of 250 in that particular question. One item to backtrack on to point out is for the distribution question, it's clear that the questionnaire asks for distributions outside of tax distributions. It's not all distributions that the entity has made, but it's the items that are outside of tax. The key there is there's been a significant change in the tax landscape that I think Lonnie is going to talk about in a minute as it relates to how PPP forgiveness has been treated, right? So for throughout the period for tax planning, there's been potentially there could have been distributions that were made that would today look like are in excess of tax required distributions, but it's important to look at those at the time that you made them and what your taxable income giving the landscape that the IRS painted at the time. So a lot of these things have to be, properly addressed and properly supported, so you don't end up really reporting a distribution that while today is not going to get used for tax because they changed things on the 27th of December, when you made it, say, for your third quarter estimate in September, would have been actually made as a tax distribution.
That's a very good point, because we did have some clients, Ali, where to lessen the blow, let's say, or to help manage their cash spending, they opted to pay in, anticipating the non-deductibility in the first 3 quarters. So there were significant tax distributions prior to all of this.
And Lonnie and Ali, that drove me, it just got me thinking about one of the questions, as we read that distribution, it talked about, the tax on the distribution. And again, that's why I mean it wasn't written by accountants, but it didn't talk about any of the tax that you paid for your prior year taxes. And with the change in, taxes not due till July 15th,
Right.
I've taken the approach that those were also tax distributions because I had to make those taxes paid in July, which was during my covered period. So is that kind of the same thing that everybody on this call is looking at as well?
Yes, that would be my understanding. Essentially, anything that you can make an argument that it is for, now that the questionnaire seems to suggest that you're only looking at estimated tax payments for quarters, that are the first 3 quarters of 2020, and they give this little blurb that talks about it, being based on 110% of last year's tax liability. So that's what they seem to suggest. But to me, you would argue that maybe some of the items that was a distribution should have been accrued as a tax distribution in prior years, and it's really a payment of last year's liability than a distribution. But anything that you can show, even though the questionnaire doesn't explicitly say it, if you have a good paper trail that, hey, I took this money to pay, a tax return or a tax bill due or whatever it is that you can tie to a tax payment, should be able to be excluded from this. Because again, they're trying to get after, did you take money outside of tax realm that went to the owners during this period or not, right? And if none of that money went to the owners, it should be excluded from having to be reported.
Ali, can I pepper you with a question that I've heard? And I guess I'm kind of jumping ahead, but with the ability now to change your covered period or to select a covered period of other than just the 24 weeks, how does that change the questions or in answering this questionnaire? Because if I had someone who took his large annual distribution in September, and so now he has the option to do less than the 24 weeks, so he could cut it off in August, does that conveniently eliminate having to disclose the distribution on this questionnaire because it's no longer in the covered period?
You know, that's a very good question, Lonnie, and I don't know that I have an actual answer. I'd love to also hear Chris' thoughts on that. My personal thoughts is, you know, they're probably going to reserve the right to take a look at the covered period as they define it to be the 24-week period that is from the date that you get your money till the end. Even though
Mhm.
that for forgiveness purposes, again, because again, this is more looking at the necessity of your loan, right? So the definition of covered period is, you know, that 24-week period from, but for forgiveness purposes you have the right to select any period that's in between. Now that's not less than 8, not more than 24 weeks. But I have a feeling that from this angle they are reserving the right to take a look at that 6 months period and see what materialized in there to determine necessity. Chris, your thoughts?
I would agree, Ali. I think you can't intentionally avoid distributions hide because you're intentionally trying to hide it from the SBA. The whole purpose of the loan was to keep people employed for payroll, not to obtain a windfall. And they might look at the distribution as though it was a windfall, so they're going to see where that money went, right? Um, so yeah, I would agree with you.
Yeah, no, I definitely agree with that as well. This is kind of goes back to Jerry's comment though, but I think they've lost sight of the fact that the certification was supposed to be from a specific point in time, right? And they keep extending the looking period for when that certification has been made. So it was really only supposed to be when you signed and made the loan application. If things changed, you know, a month later, 2 months later, 3 months later, um, you know, somebody made a comment is what would be good faith execution of the certification? Well, you can only have good faith based on what your knowledge was at the time you signed the certification, right? You can't have an ongoing requirement to revisit that certification. You made the application, you signed it on a date certain. The good faith should be judged based on what was in what information you had at that time. So this is kind of really, I'll refrain myself like Jerry did, but really structured unfairly in a lot of ways, these questions. One more question on the questionnaire, and then I want to move forward and talk a little about the Consolidated Appropriations Act and the changes it made. But both question 8 in the first section and question 13 in the second section give borrowers 1,000 words to explain, amplify, put further context on their answers in the questionnaire. And I don't know who at UHY, does somebody want to jump in, and maybe Jerry, and talk about how you're recommending that your clients use that space in question 8 and question 13?
I mean, I'll add my insight and then I'll let Ali and Lonnie add theirs because they've really done a lot of these. I've done a couple of these on this 1,000 characters and it's difficult. You got to really focus on where your disruption was. What you want to do is point out in that 1,000 characters to get across the disruption you faced, you know, whether it's exemplifying the cost you had to pay to get everybody to work from home, or whether it's, you know, the fact that you were still under orders that maybe weren't exactly what we call stay-at-home orders, but they were still work-at-home orders. So you really got to emphasize the points of what you're still dealing with today and what you dealt with back then to really show that you are still having major issues. I have seen, you know, some of ours where we've put dates of what happened. We've had the dollar amounts allocated to the work from home costs for each employee rolled up. You know, it's been all over the board. And I know that, you know, I've relied very heavily with, you know, the team inside all of UHY, but also the client. You know, I think one of the smartest things we did was get all our clients when they first got their loan to put together their own narrative in paragraphs of why they felt they needed the loan. And so a lot of them have taken that, whether it's a page and a half or 3 pages of notes, and, you know, squished it into 1,000 characters. Ali, Lonnie, want to add any more to that?
Sure. From my perspective, I think those, some of these questionnaires, almost tell a story by themselves. You look at a client, their Q2 revenues are down 60%. It's like, what else do you want me to tell you? But it becomes very, 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 very imperative to fill this out the right way if all of a sudden your sales are the same. And that's where you want to tell the narrative. Because again, the hindsight wasn't there. A lot of companies were able to pivot their business, change their product offerings for something that was more suitable to the pandemic. And that's where, unfortunately, 1,000 characters is never going to be able to describe what you went through or what you're gonna, how it impacted your business. But you want to kind of focus on, if my revenue stayed relatively consistent, why did it stay relatively consistent, right? So what happened? Did you shift your product model? And make sure that you emphasize that you would have never been able to get there, hopefully, without the PPP money, right? So that bridge was required. You had to do X, Y, and Z, and that bridge was required to get you there, right? And then the same goes with the liquidity, the question on the liquidity. If you have a strong cash balance at the end of the quarter, that's going to pop up and make somebody just at first sight look at it and say, well, that really, you didn't really need it. You want to be able to explain what that cash balance translates in those boxes to, right? Oh, hey, if things went the way I thought they were going to go, maybe that was 3 months worth of working capital. So don't look at the fact that I had millions of dollars on my balance sheet and think of it in your terms of millions of dollars, because you're not being able to benchmark it to my needs, my payroll, my overhead. And so you want to always try to translate that to some sort of that metric so that you can paint why, like I've seen people where they even have cash and, they wrote in, well, the owner had to go and borrow personal money and also pump another $1.5 million subsequent to the fact, right? But there's nowhere you can show that on this questionnaire. So the cash that was on the balance sheet at first glance looks good, but it really wasn't, and they had to even pump more money. So those facts become very relevant to try to highlight in these small paragraphs.
I think that you said something that's really important there, and that is to really look at how you've answered these questions and let that determine if and how you use these sections. So I'm not a litigator, I'm a transactional attorney, but I've heard some of our firm's really great litigators say you have to understand when you're ahead, right? And they would say, sit down and be quiet when you're ahead in court. So I think you made a great point, right? Especially in that first section, if your revenue is down in 2020 Q2 compared to Q1 of 2019, there's probably no reason to say anything at the end of that section. Just let it speak for itself, because that you could probably only say something that could raise an issue. I think the liquidity section, though, is where folks almost always need to make an explanation. Something that's glaringly absent from the liquidity section to me is access to, to capital outside of your company, right? In the staffing industry, it's ABL loans, right? There's no questions about that. So, that's part of the context of understanding liquidity as well. And I think that the liquidity question 13, probably most cases, people are going to want to put an explanation in there. We had a client who, seemed to have a big cash balance, like you said, but their borrower actually had reduced their ABL borrowing facility in April, right before they took the loan. And if you really looked at what their cash needs were, and you took into context that they had their ABL reduced, it was clear that they needed the money. So I think you have to really look at how you answer those questions. Let's move on to the Consolidated Appropriations Act and the changes that it's made. Chris, let's start with you. My understanding is that the act made some additional expenses eligible to be counted towards forgiveness. Is that true? And can you explain what they are?
Sure, Marty. Yeah. So it keeps the same expenses that you had in the first round, which is the mortgage, interest, rent expenses, and utilities. And it added 4 more categories. It added covered operation expenditures. This includes payments for business software or cloud computing, covered supplier costs. Again, this includes goods that were essential to the business at the time the expenditure was made, and such expenditures were made pursuant to a contract. Covered worker protection expenditures. So these are your PPE, compliance with governmental requirements, ventilation systems, outdoor space. And the fourth one was covered property damage. Obviously, a lot of people's businesses were damaged by looting or vandalism in 2020. So those are insured, or those are valid expenditures.
Chris, also, it provided for a more simplified forgiveness process for loans under 150,000. Can you talk about that really quickly?
Yeah, sure. So the new simplified process for loans less than 150 are not going to be more than 1 page in length, and are only going to require that the borrower provide a description of the employees retained, the estimated amount spent on the payroll, and the total amount. We're assuming it's going to look a lot like 3508S, which is currently used for loans less than 50K, which just provides a certification and a very few numbers. We're recommending that people with loans for less than $150,000, probably wise to wait for this new forgiveness application to come out. Save yourself the time and energy of otherwise filling out the 3508 EZ or the 3508.
Thanks, Chris. Ali, two important parts, I think, with the act. One is that the second round of PPP loans, and also the notion of increasing your loan. Can you talk about those two aspects of the act?
Sure. We'll start with the increasing the loan. That is essentially a little bit narrower in scope. Seems to be applicable to partnerships and seasonal employers mainly, and some farmers and ranchers. Partnerships who didn't calculate their loans the first go around, didn't include SC income or guaranteed payments in for general partners, can go back and get their loans increased for that. Same thing for seasonal, can use a 12-week period now between February 15, 19, and 20 if it yields a better result, to go back and get probably a higher balance. And entities who didn't get their full max loans the first go around, or didn't accept the full max, can go back to get that money now if they feel more comfortable doing so. As far as the second loan goes, essentially PPP2 is eligible now eligible for companies who are a little bit less or smaller than the original go around, which impacts the staffing industry tremendously. The companies now are strictly 300 or less employees. They've added some more eligibility for 501c6s and some news organizations, as well as destination marketing. But really what they did is they now are going more of a hard count on employees. 300 or less are who's eligible for PPP round 2, and then you have to prove that you had a reduction in revenue in 2020 in any quarter compared to 2019 same quarter, assuming you were in existence for the whole 2 years, of 25% or more for you to qualify for round 2. As far as the mechanics go, though, once you're eligible to qualify, you can essentially get the same amount that you got in round 1, as well as using either 2019 data or 2020 if it's more favorable. But the calculation of the loan is identical. So for those who are just relying on 2019 and that's what they did the first go around, they will exactly get the same amount of the first PPP. Worth noting, though, that the certification itself remains in PPP2 as well as in PPP1, right? So that same uncertainty, you're now pushing into January 2021, having to look today, and now we know how the SBA has been looking at this stuff, trying to analyze whether you can feel comfortable making those particular certifications for a second go. So it's not automatic, something to consider, especially for companies who are leveraging maybe a drop in revenue in Q1 of 2020, for example, or Q2 when the pandemic was at its height, but have since recovered in Q3 and Q4 going into this year. Are you comfortable making that certification the same way you were when the pandemic first started?
Yeah, Ali, let me take over a little bit for you here. Couple things to point out too, Marty. is, as Ali was talking about, the 25% reduction. I want everyone to remember that if you are a staffing firm and your average is under 300 FTEs, or not at 300 employees, I want to point that out. It was not FTEs. It is 300 employees. You know, you could have a quarter that was 24%, and then you could have another quarter that was 10%. And then the whole year is 25%, because that's mathematically how it worked. So be aware of that if you are still struggling, it is the 25% per quarter, but it's also the way they've put it together is that if it is a 25% reduction for the calendar year, then you also are going to be able to go to that loan as well. So make sure that you are absolutely looking at quarter to quarter and then looking at the whole year, especially if that certification piece is still beholden to the fact that, you know, your employees are still well below what you normally are. You're still suffering, you know, and all those other things we've talked about so far. But I just wanted to point that out because it was important. You know, someone did just ask the question, does the economic necessity safe harbor for loans under 2 million apply to the second draw? It's our understanding, Marty, that yes, they still will be. However, as everything's been changing, you know, it's not to say that 2 million, you know, might be lower, but the rules are still the same. But I'm sure Chris would also reemphasize, this is now section 37 under the 7A rule, not 36, and some of it goes back and forth. So Chris, I don't know if you had any comment on that, because I didn't specifically see that in there, but I do know they point it to 36. So my assumption is it's still going to hold true.
Yeah, I would agree with you. It's still going to hold true.
Okay.
Yep.
But here's my warning. PPP2 is clearly intended to be very focused, a lot smaller, a lot more limited. So today it's 2 million, but I wouldn't be surprised if for PPP2 that changes down the road. It just seems like the intent is really to shrink this up and to really make sure that not that folks didn't need it, because I believe everybody did need it who took it the first time around, but to really shrink up the base of eligible borrowers. So I wouldn't be surprised if that changes down the road.
I mean, unfortunately, Marty, you're the attorney, so I will go with the attorney's confidence on that one. How's that?
Well, Lonnie, I want to get to you because one of the big issues I know, we spend a lot of time with our clients, and we spend a lot of time with our own law firm, you know, before this act came down, trying to figure out the tax consequences of forgiveness and deductibility of expenses. Did the act finally put that to rest?
It absolutely did. Conveniently after we had done a whole bunch of our tax planning, right? But no, it did, as the act was written, that there would be all expenses paid with the PPP funds would be considered deductible. And to confirm that, the IRS had to eat crow in a sense, and they did issue a new revenue ruling 2020-2, in that it specifically says that the previous 2 notices and revenue that they had sent about the expenses not being deductible are declared, as I quote, obsolete as of the effective date. So those 2 no longer apply. So all the expenses paid with the PPP funds are deductible.
Now, one thing that we've been reminding our clients is about state law and how the deductibility. I know in California, for example, California is not allowing folks to deduct the expenses for state tax purposes. Can you amplify on that a little bit?
Yes, I would add, before I say give out any of these states, that so a lot of it is, you know, some states haven't made any types of provisions or specific rules to this yet, and some of the states that are right now where the expenses may or may not be deductible are simply because they're the way that state's code is written, tax rules, is that it doesn't necessarily conform to the IRS's or other positions as of a certain date. So right now, there's a handful of states out there that don't necessarily conform to the tax treatment. So given the interest of time, we don't have to go through them, but just know that be sure that you're talking to your tax provider, and it may be different depending on, if you're multi-states or different locations. So.
And also, I believe the act changed the ability of borrowers to make ERC credit claims. Is that correct?
Yep. So actually, there was an employee retention credit that was part of the CARES Act back in March, and as it was originally written, you couldn't have both a PPP loan and the employee retention credit, but the Appropriations Act changed that. It did change the words, and it did it retroactively, that if you had previously had a PPP loan, that you can in fact take the employee retention credit now that, or if you met the eligibility tests. And so the Appropriations Act actually did two things to the employee retention tax credit. It revamped it, let's say for 2020, in that anybody that had the PPP loan could do it. So the two requirements, just big picture, are you have to have at least a 50% reduction in gross receipts for a quarter. And then there's some employee threshold limitations. So if you have more than 100 employees, you essentially had to be paying people not to work to be eligible for the credit. And the credit was up to 50% of 10,000 in wages. So 5,000 per employee is what it works out to. But what it did for 2021 is it enhanced that credit in that the credit for wages paid after January 1st through June 30th of 2021 is it's 70% of those $10,000 wages per quarter. So it could potentially be a credit of $7,000 per quarter. And these are, keep in mind, these are payroll tax credits, not income tax credits. And so the gross receipts reduction, for 2021 is more than 25%, and the employee threshold was 500. So it did, what I'll say, extend and amplify the credit for 2021. But just something to caution is that there are aggregation rules. So related entities, so for both the gross receipts reduction and the employee count, there are aggregation rules. So any related entities would have to be factored in as well.
Thank you, Lonnie. And we have one more question. Why don't we take that last question? I don't know, Jerry, if you want to take that, or Lonnie, or Ollie.
Why don't we let Chris go ahead and do that?
Okay.
I like hearing Chris's voice, and I want to make sure everyone understands, because this is a legal question more than it is the, a methodical accountant question in my mind, Marty.
That's great. Chris, do you see that question? Can you respond to that?
Can we apply for a PPP loan too and have not asked for a PPP loan questionnaire?
Yep.
So yes, you can. As long as you've submitted and you've used the funds for the correct purpose under the first PPP loan, you can go ahead and apply for it. And that doesn't guarantee that you're going to achieve full forgiveness or that they're going to give you even partial forgiveness. It just means that you can go ahead and apply for it.
Thank you, Chris. Well, Jerry, Lonnie, and Ali, it's been wonderful to have a chance to talk PPP with you again.
Yes.
I hope the audience benefited from, these kind of issues that are out there and really the focus of this home stretch.
Yep, we really greatly appreciate both you and Chris being on today. We appreciate all the audience staying over a little bit. We apologize for running over, but there's some great questions coming in, Marty, and it still tells me that there's still a lot to be done for people to really maximize this forgiveness. But more importantly, I'm sure we're going to do a second presentation on PPP2 and the ERC as we start seeing some more clarity wrapped around that. Do want to let everyone know all our contact information is on the screen for you. Please feel free to reach out to any of us. And as always, thank you. And we look forward to seeing you on the next webinar. Thanks so much, everybody.
Thank you.